So we're going to talk a little bit more about risk management, and this was a topic we talked about a couple of weeks ago on the program, but I'm going to sort of overlay it with sort of the current market environment and what we see economically out there and why it's so important to be perhaps cognizant of risk management, particularly in the current environment. We'll tell you why, and of course, most importantly, how you can address said balancing risk and reward in your own personal life and investment portfolio. And then, are you interested in retiring early? I know, shoot, everybody likes to kind of talk about that. We're going to give you some key boxes to check to see if, in fact, you can retire early. So if that's a topic of interest, stay tuned then as we make our way through this week's edition of Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of the top 25 financial planning podcasts out there, along with a long-running radio program. Catch us on any of those favorite platforms. Go to our website at nelsonfinancialplanning.com. If you can't find our channel on said platforms, you'll see many ways in which to connect directly. Once there, make sure you subscribe, and then that way you'll get notified when we upload new content. My name is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of folks. You get to hear from them every other week. It's kind of how we do that. If you're regular listeners to the program, we follow somewhat of a structure, if you will. Every other week, it's just me sitting here by myself. On the other weeks of every other week, we're usually joined by one of the folks on the team, one of the fellow certified financial fiduciaries at Nelson Financial Planning. So if you're bored with just listening to me, don't worry. Next week, there'll be somebody with me, or I think actually next week, Kristen and Chet are going to be doing the show together. So you don't even have to listen to me next week. So some of you may like that. Anyway, we are here to talk as we do each and every week. And I guess first things first, happy autumn, if you will. First official day of autumn was this past Monday. Hard to believe October starts on Wednesday. So coming up into the last quarter of the year, and always amazing how quickly time flies. And it really got me thinking of another sort of statistic that I saw this past week, thinking about things that existed in the past that don't exist sort of in the same format as they do today. And got to thinking a little bit about stock certificates. And in connection with that, we saw an interesting stat where there are still, if we think about stock certificates, paper stock certificates, sort of those things of a bygone era, because most of the time these days when you buy 100 shares of company X, you own it electronically, right? You don't actually get the physical stock certificate. But as the most recent estimates have it, there's still about $750 to $800 billion worth of sort of stock certificates that are still sort of floating around out there, whether they be in old security boxes or safe deposit boxes, or just maybe in someone's sock drawer. There's still a lot of them out there that represent sort of that bygone era. So we thought we would kind of talk a little bit about it, and kind of what you do if you've got one of those, or if you find yourself the beneficiary of one of those stock certificates. And, it's funny, a lot of the stock certificates were kind of interesting or intriguing in terms of kind of, what they look like. I mean, the Disney one, have you ever seen a Disney stock certificate. It really is kind of almost like a little bit of a work of art, as you sort of would expect from Disney. You know, the picture Walt's face was kind of in the middle of the stock certificate in gray, but then all around him were all the Disney characters in color. And, you know, to the right was Mickey, to the left was Donald, and then there was Cinderella, there was the Chipmunks, there was Winnie the Pooh. I mean, it was all in color. It was really kind of a work of art. Many people were always sort of reluctant to give those up because they were such a little, you know, nice looking piece of paper. And but the problem is that if you have a stock certificate, you can't really sell it without submitting it to a third party, because the days of you handing somebody a stock certificate isn't really the days that we are in today. So certainly there's still a tremendous amount of them out there. And we thought it would be good to kind of walk you through sort of the process, because clearly there's, you know, tremendous amount of value that's still tied up in these, and they're just kind of floating around out there. And the reality is that in today's digital trading world, you know, these paper stocks are really kind of relics of that bygone era, and certainly difficult to just easily sell them. If you want to sell them, then you actually have to kind of send them in. So here are some of the steps that we would urge you to consider, because sometimes when you find these stock certificates, they're not really worth anything. So the first thing is to assess the value and understand what it is that you have in front of you. So you would start by looking at the stock certificate and examining the company name, the number of shares that it's printed on that stock certificate, and then the date on the certificate as well. So from there, if it's a business that still exists, if it's a business that you're familiar with, so maybe it's Disney or Walmart or something like that, well, yeah, we all know that still exists. But sometimes it might require a little bit of detective work where you're looking up that particular company, trying to track down, okay, did this company merge? Did it get bought by another company? Is it no longer in business? The good news is the business still exists. So let's just say it's Disney or Walmart. But then in that case, you can call the investor relations department, or even sort of a reputable kind of financial site will tell you whether it's a publicly traded company. And then the other piece of information that's sometimes on these stock certificates are, although not the super old ones, but there may also be a QSIP number on it. And that's sort of an identifying number that would allow you to also track down exactly what that or where that company might be, or what the value of that company might be. So it starts with sort of identifying what it is that I've got here, what's the current status of this particular company, and then ultimately what, is their value here, right? So if you've gone through that step, the next step is usually trying to figure out who the transfer agent is. So the transfer agent is typically the firm that handles the stock ownership records, and those typically are the ones that can confirm whether that stock is still valid, or whether it's no longer valid because there was a new certificate issued, and so that one really is just kind of trash, or not. So that's the purpose of kind of contacting the transfer agent, is to really sort of run through that analysis of, okay, yes, this is a company. Yes, it's still a company. Yes, there's value, but is this stock certificate really a real certificate that entitles me to that ownership of the number of shares that's on the certificate? That's kind of what the transfer agent does. And so the issue there, of course, is that if you inherited that stock, then you might be having to go through a probate process. So one of the suggestions that we always make is, if you do have these physical stock certificates, you probably want to deal with them and not ignore them, because they're kind of a pain for your beneficiaries to really go through and figure out what needs to be done. Plus, they may not know the full story behind that particular company, and you would be the one who would know that story, so you would be able to better direct how that stock certificate may actually be converted over to dollars. So when you've got that then so you've gone through the process of assessing value, contacting the transfer agent, and then ultimately it's about selling that stock. So you can either typically sometimes do that through transfer agents that will allow for a direct sale service, or you may have to use a brokerage account in order to do that. So some important stuff as it relates to those physical share stock certificates. We thought we would start the program off on that topic. And then, of course, we'll continue here on Dollars and Cents after these messages. Back on our September 7th show, so a couple weeks or so ago, we were talking a little bit about, I guess that would be 3 weeks to be exact. We're talking a little bit about kind of risk management and sort of introducing that topic and talking about sort of what it is and why it's important and how you can kind of, effectively manage that in your own personal finances. And so to just briefly recap, obviously risk management involves identifying and analyzing and ultimately mitigating potential downsides of an investment while balancing the potential rewards, right? I mean, it's at its core, it's about balancing risk and reward, as risk is inseparable from return. Even sort of the most conservative investment from sort of low-risk treasury bills has some level of risk on up to sort of higher risk emerging market types of stocks. Higher risk typically comes with higher reward, but it's important to be able to stomach that risk and that potential for volatility. So certainly some trade-offs. Obviously, risk management can take many forms. You can talk about, obviously, we talk a lot about it on an individual level, but it can also be important on an economic level. If we think back to 2007, 2008, so what's termed as the Great Recession, a lot of the issues there came from a systemic ignoring of risk, particularly when it related to the ability to just kind of borrow money on a whim. Once you do that on a large scale basis, you can then create a lot of risk into the overall economic system. Sort of key takeaways for managing risk that we talked about on the program 3 weeks ago was the notion of course, the importance of diversification, right? It's helping to kind of balance out that risk. Understanding what your risk tolerance is, what you're going to be willing to accept and what you're not willing to accept in terms of how much your portfolio swings on a regular basis. Setting clear financial goals, always, an important step. And then, kind of lastly, regularly reviewing your portfolio. So that was kind of the key takeaways or the key summary of kind of what we were talking about on that program 3 weeks ago. But I wanted to kind of spend some extra time on this topic this week primarily because when we think about the overall level of risk in the market today, it's relatively high, and we see that in a lot of different ways. We see that in market concentration, which we're obviously going to talk a lot about in this segment, but we also see it in terms of kind of what we would think of as risk on types of assets. So in that category, we're going to kind of throw in like crypto and things like that, where you've got these assets classes that are relatively new that might not be as fully understood as kind of what the general public might comprehend. And you see the value just going up and up and up and up and up and up and up. And, the greater the number keeps going up, or the value of that keeps going up, and the more people that kind of jump into it, and the more the value kind of keeps going up. At some point, the more you kind of ignore the risk that is inherent in that asset, the greater the potential for any kind of hiccup having a much more significant impact. That's the problem with risk, is the more risk that you sort of have in the system and the more it remains unchecked and the more it gets ignored, the greater the comeuppance, if you will, is. So this is one of those things where you've got to be thinking about it as an investor and ultimately have a plan in place, not just a plan that, I'm going to implement it when that happens, because when that happens, it'll be too late. So you want to kind of have a plan to address this now when things are going decently well, so that you are prepared. Because if you wait until the bad period of time, it's going to be too late. So let's set the table kind of in terms of where we are now, or kind of how we see the landscape. So we've talked about the market being heavily concentrated in a handful of stocks, particularly in the tech sector. That has continued and continues even more so. So if your portfolio is simply tracking the stock market as a whole, you're probably taking on much more single stock or individual company risk than in the past. Because, for example, the top 5 stocks in the S&P 500, which is supposed to be 500 companies, those account for almost 28% of that overall index. That is up from under 12% just a decade ago. So you got 5 stocks, now 28%. That is a much narrower band of companies that are driving the market. It also gives you a much narrower roadway for the impact of when things don't go as well. That also, kind of leads to a lot of group thinking. And that was one of the cognitive risks that on that September 7th show from 3 weeks ago, because Zach joined me, Zach Keister, fellow certified financial fiduciary at Nelson Financial Planning, joined me on that program. We were talking about some of the, sort of the cognitive biases that can impact our return over time. And that was kind of one of them, that group think type of mentality. And you can see that even in the financial services industry. Financial services industry is not immune to this notion of groupthink. And, because financial services industry, of course, made up a bunch of human beings. And so then you can have these cognitive biases that come into play. And they can come into play pretty dramatically. And, nowhere I think is that groupthink more prevalent than sort of in the analyst or expert forecasts of what's going to happen with these, small group of companies. So if you think about companies like Microsoft, Facebook, which is now Meta, NVIDIA, Alphabet, which used to be Google, the agreement on forecasts in terms of what these companies are expected to do going forward is really the tightest that we've seen in several years. And so that kind of group thinking does in fact increase the vulnerability of the market to sort of sudden reversals and setbacks. And then it gets you to the second problem. Understand that those companies are all, kind of being driven by one big bet, and that is artificial intelligence. If you even go further and say, okay, the 8 largest companies in the market, it's all kind of, okay, how are you going to do on this whole AI stuff? And that's pretty significant when you have all of those. Not only is the market concentrated in a handful of stocks, but all of those handful of stocks are in this exact same industry, and they're all chasing after this one artificial intelligence. Expected expenditure on that this year alone for that group is going to be, almost $400 billion just in the single year. So I think the question you got to ask yourself is, wait a minute, are all these people going to achieve the same level of success as this? I mean, history would certainly suggest that there's going to be some winners and losers on this thing. Companies that make the right moves, companies that that don't for any number of reasons. Throw in the ability or the inability to kind of figure out, okay, how are we going to monetize this, right? I mean, you think about the internet. That was big, dramatic. So too was the provision of electricity 100 years ago, which is why utility stocks were obviously the big stock market winners of 100 years ago, but not really today. And so, at some point you got to start to think about that as it relates to artificial intelligence. And then the monetization side of things, like how do you wind up, kind of actually having it be reliable enough? Because even ChatGPT-5, estimates that 10 to 20% of the answers are kind of like totally made up. So that's fine for social use, but not exactly fine if you're, trying to make a dollars decision on it. And so, kind of how does that all play out? And then the last problem is, when you look at comparable time frames, you certainly have seen the same level of concentration, but there's a significant sort of twist to that. And we're going to cover that after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning. We're talking about risk management on today's program. Sort of a follow-up from sort of the general topic that we talked about 3 weeks ago. We're kind of delving a little bit deeper into this because we do think that the current environment does suggest, based on sort of where things are, that we've got a sort of unique set of circumstances that are lining up in the market that suggests that people are kind of ignoring risk management. People are not necessarily paying enough attention to it. So we're outlining kind of 3 problems in the current landscape, and then we're going to get to some key takeaways that are going to be super important for you to kind of really make sure that you're following with respect to your own personal finances. So the first issue that we talked about was obviously the concentration in the market. You got the 5 largest companies in the S&P 500, so that's supposed to be 500 companies, but the 5 largest are making up almost 28% of the performance of that index. Folks, that's called concentration. If you take that one more step further, which gets us to the second problem of the current landscape, one of the things you'll notice is, okay, well, the 8 largest companies are all happen to be chasing after one bet or are all in one sector, and that is technology, and that bet happens to be this artificial intelligence. And, hey, who knows how all of that plays out? Some of them are going to win big. Some of them aren't. And the reality is that, all of those companies, though, are all kind of chasing after that artificial intelligence type of sort of conversation that's on everybody's mind these days. And, before you get there, you got to figure out how to monetize it, right? I mean, the internet was, probably had similar buzz once it was widely adopted, but the issue with monetizing the internet became very, very different than kind of what the original expectation was. You could certainly see that same thing happen with the AI side of things. And then the third problem, which we were getting to, but then we had to take a break, and so now we're back, is that when we look at the concentration of the top 5 stocks, so it's not like that's never happened before. It's not like the top 5 stocks in the S&P 500 haven't accounted for roughly 28% of the total market. That has happened before. You got to go back to 1964 though to find that, which, if I'm doing my math correctly, is a good number of years ago. And the key differential is back in 1964 when the 5 largest companies were made up roughly around that same percent of concentration. It was a telecom operator, it was a oil company, it was a car maker. I mean, they were in different sectors of the economy, very different companies, very different sectors. Remember, one of the ways in which you can kind of offset risk is through diversification. So if all you're owning is these companies are all making the same bet in the same kind of sector of the economy, you do have to wonder, okay, what's my personal risk management that I'm actually being mindful of when it comes to my own personal portfolio? Let me get to our key takeaways then against that backdrop. First, you got to recognize this sort of increased risk that is in existence in today's market. That single stock, single company risk is at its highest point, since 1964. So what that means is that diversification is much more critical than ever in order to attempt to mitigate that risk. Diversification, remember, not all my eggs in one basket. That applies not just to eggs, but also to the components of your individual portfolio. After all, that's what we're talking about. Number 2 is you got to be aware of this concentration that is in AI. Everybody's kind of making the same bets, and the potential vulnerabilities that exist there, right? Whether it be through monetization, whether it be who's ultimately going to be the big winner and who's not. And the third item is to watch out for kind of this cognitive bias of groupthink, and certainly we talked about that previously, but this is a pretty significant example of groupthink, particularly not necessarily when we're talking about the general public. I mean, that's general public, you kind of would say effectively you sort of expect that, but when it's Wall Street analysts that are all predicting the same forecast for all of these handful of companies, and you see that the range of those forecasts are the narrowest that they've been since, many, many years. You got to stop and wonder, okay, if the consensus is all kind of the same, then perhaps there's a lot of groupthink going on inside that consensus. Here's the most important thing, and here's how it really relates to your own portfolio. The question we ask is, do you know what your exposure is? Do you know what your risk is in your portfolio? I mean, the importance of being diversified and having the right allocation and understanding your risk tolerance is that you have an understanding of what that looks like in your own personal portfolio. Those are the kinds of analysis that we run on a daily basis for all of our clients at Nelson Financial Planning, because we really do think that this concept is crucially important in terms of achieving long-term investment results over time. And so if you haven't had one of those run for your own personal portfolio, we encourage you to reach out to us and ask for that analysis. We do that for free, so no commitment, no obligation one way or the other. Just a way to really educate yourself about your own personal portfolio. So if you're interested in taking advantage of that free offer, go to our website at nelsonfinancialplanning.com and just put in your name, number, say, hey, was looking to kind of get a better understanding of the risk in my own personal portfolio, and be happy to run the analysis, send it to you, go over it with you, and hey, if the goal is to help educate, then that's a great opportunity to be able to help educate you on what that looks like in your own personal portfolio. Speaking of things that folks like to do personally, one of the topics that comes up on a regular basis is this notion of, hey, you know what? I want to retire early. Now, hey, to each his own. I have no intention of retiring. Love what I do, and love the people who help me do it every day as well. We got a great team of folks at Nelson Financial Planning. They obviously make my life much, much easier because it's a full team approach. So it's not solely dependent upon what I do. Obviously, if you're regular listeners of the program, you get the opportunity to hear from them on this program too on a regular basis. But for those that, say, hey, I want to retire early, we thought it would be good to kind of cover some of the things that you probably want, or boxes that you need to make sure that you're checking in order to be able to be eligible to retire early. So that's what we're going to be talking about here in the next segment here on Dollars and Cents, giving you 5 different key things to be thinking about, or hopefully things that you can say, yes, that is me. And if you say yes to all 5, guess what? You're probably on a great path to be able to retire early. So stay tuned for that after these messages here on Dollars and Cents. So you hear about retirement all the time, you plan for retirement, all kinds of conversations about how best to plan, how best to prepare. And at least, obviously, if you're a regular listener to this program and podcast, we talk a lot about that. Lots of numbers, lots of concepts, tax efficiency, where to get money from, how you're going to generate income in retirement. We thought it would be kind of neat to actually cover some things that, or some boxes, if you will, that you can sort of work through and check to see if you can retire early. I mean, obviously that's a popular conversation. A lot of people would say, man, I just don't really like my job and would like to retire early so I don't have to go into work. Well, here's what you need to know and the questions that you need to ask yourself. We'll start off with the importance of good health, which you would say, wait a minute, Joel, why are we starting off sort of a conversation about the things that I need to be aware of if I'm going to retire early with my health? How is that possibly related? It's related because if you have health problems, then one or two things are going to happen. First of all, the cost of your healthcare and related expenses are going to be much higher. So that's going to cost you more money. So if it costs you more money, then you probably shouldn't consider retiring early. That's number one. And of course, number two is if you're not in good health, then you're probably not going to enjoy your retirement quite as much. If you manage to take better care of yourself, perhaps by quitting smoking, limiting alcohol, regularly working out, then the reality is you could get some savings on things like insurance premiums, be less exposed to those out-of-pocket costs, because certainly healthcare costs can do a lot to make or break your retirement. And the cool thing is we actually see this quite a bit. And I guess maybe this is a reflection of society today where, we see a lot of clients as they're approaching retirement say, wait a minute, I'm going to really work and try and get myself in better shape. I know one couple that between the two of them, they lost like 100 pounds in sort of they started to kind of prepare for retirement. And for them, it was an early retirement, and really kind of start to think about, okay, how do we get in better shape to really be able to lean into and enjoy and travel and hike and do all the stuff that we'd like to do in retirement? Well, if we're going to do that, and that's what we want to do, well, then we can't do it when we weigh 100 pounds more than kind of what we do now. So they went on this workout routine. They obviously eating right, all of that, and lost about 100 pounds between the two of them. Of course, the reality is one job, one of them was working in sales, one of them was working in transportation. So those are kind of sedentary jobs. So it's easy to kind of put that weight on over time, and yeah, they started a regular exercise routine, focused on a healthier diet. I think last count, they were over in Europe doing some hiking in the mountains over there, and enjoying that. So, yeah, the ability to retire early starts with first a little bit of a health check, if you will, on kind of where you're on that. The next is looking around the house and counting how many people are there. If it's one, and you and your spouse, two, and it doesn't go to 3 or 4 or 5, well then, okay, that's another important little box to check, because the impact of having financially dependent dependents can be significant on your finances. The reality in today's world is that 50% of parents with children over the age of 18 were still continuing to give some form of financial assistance to those young adults. On a side note, I saw a crazy stat on this. I got to read this to you because it just was like, what? I even took a picture of it and sent it to my wife. So this is a recent survey of 831 full-time employed Gen Z adults who are between the ages of 18 and 28. So this survey, 31% had a parent write their resume. 77% brought a parent to attend a job interview. That's bizarre, right? 73% have had their parents help complete work assignments, and 83% have had their parents pack their lunch for work. I don't know if that's totally related to what we're talking about, but that was a statistic that I'm like, wow, okay. Unfortunately, if you're doing that, then your housing and your cost of living, all of that has increased quite a bit. And obviously the cost of housing has pushed many adults, or young adults, into their into their parents' home. But it makes a difference. Having a dependent reshapes your financial situation and could certainly be a deciding factor into whether or not you can retire early. So if you're part of the half with the independent children, or nobody, based on that earlier statistic, then congratulations, you're in a better position to retire early. By the way, Garris household not immune to this phenomenon. So I feel your pain, if you will. 3 weeks ago, my eldest son moved back in. He got a job offer within the Orlando Magic organization. Actually, he's working for their G League team, the Osceola Magic. Super excited to have him home. Don't get me wrong. I'm not an evil parent. I like having my kid home. It's great. Although it does kind of change the routine. This is a job that he wanted. Super excited. It's his dream job, dream organization. He's been a Orlando Magic fan. He obviously grew up in the area, and he'd been up in Indiana working for Purdue University for the past couple of years, living alone, kind of putting his time in, if you will. And obviously came back. That's great. But yeah, we're running into these issues. And kind of where to draw the line in terms of finances. And so side story, this weekend, we're sitting around, football was on, all that. He was like, hey, we're out of Coors Light. And I said, how have you been getting your hands on Coors Light for, the past 6 years? Because you've been in Indiana for the past 2 as a young adult working a, full-time job up there for Purdue. And then before that, you were at Auburn, and I'm pretty sure you managed to figure out how to get your hands on, Coors Light. So I said, you need to go get your own. Parenting such a joy, and the Garris household not immune to it. But to circle back and to attempt to stay on topic, it costs money when you're buying beer and or anything else. So make sure that you are cognizant of that, particularly if you're looking to retire early. Next up would be what your savings rate is. The reality is that this is a key factor in determining whether you can retire early is your own individual savings rate. If you're saving at a low rate because you've got too many expenses that you've got to cover, that's going to impact your ability to retire. As of May of 2025, the average personal savings rate, according to the Federal Reserve, was 4.5%. If you can push that up, then you can increase your chances of retiring early. That's one of the reasons why, as we said earlier in the program, we don't have account minimums here at Nelson Financial Planning, because we believe in helping people get started, because that is so crucial, to just get started with some level of savings and then gradually increase that savings rate over time. Fourth thing to check out is whether you got a variety of sort of buckets in which to generate out income. The more you have, the better off you're going to be, and the earlier, in fact, you can retire. Also want to watch the tax efficiency of that when you do that. That's one of the biggest reasons why we have tax preparation services at Nelson Financial Planning. And then lastly, let's talk about debt. Okay, obviously, if you don't have debt, that makes you much more likely to be able to retire early. And that one is really pretty crucial. We talk a lot about that in our book, Next Gen Dollars and Cents. And then the companion workbook, which is coming out on October 10th, has a lot in that, including some exercises about how to compare mortgages and how to decide what type of mortgage may be right for you. So there you have it. Things to be thinking about if you're thinking about retiring early. Some boxes to check, if you will. And with that, we're going to wrap it on up and get on out of here. This has been Dollars and Cents with your host, Joel Garris of Nelson Financial Planning. To learn more about us, go to our website at nelsonfinancialplanning.com. Thanks for listening to this week's episode.